Okay, all right. So let's start our class. So again, good afternoon, everyone. Today we are going to be progressing on group account. Last week we started business combination achieved in stages. And before we got here, if you remember, we started with complex group, where you have a parent having a subsidiary and his own subsidiary also having another subsidiary. And we saw that there, the parent, who is the one that is preparing consolidated financial statements, to consolidate his own direct subsidiary is very straightforward. But by implication of having a subsidiary who now has another subsidiary, he will now also be having an indirect interest and holding in that subsidiary. And he will need to incorporate that subsidiary in the consolidated financial statement. We saw how that works in different scenarios. And the principle of canceling out the cost of investment against the equity of the subsidiary still stands. That still works out perfectly, except some few additions that we considered and we explained very well. So you need to master the peculiarity of that. Basically, how to determine the goodwill, how to determine the non-controlling interests, as well as the consolidated retained earnings. Now, we then moved forward to business combination achieved in stages. And for this one, this is focused on where an entity gets control of another entity through piecemeal acquisition. Meaning that he has investments in the companies before, but that was not a controlling interest. Then he then acquired more to then become a controlling interest. Or he might have an existing controlling interest, but he acquired additional holding to increase his controlling interest. Those are the two major accounting issues here, which means that the business combination in stages we are talking about here is the one where control is involved, where controlling interest is involved. So when we have a scenario where controlling interest is not involved, like from probably maybe you have less than 50%, maybe you have 20%, you now bought additional 20 that gave you 40. That one does not apply here. That one will apply in his own right, whether as associates or financial asset, depending on the holding and the substance of that investment. For you to apply what I'm teaching you here, there must be controlling interest. You must cross that controlling interest boundary. That maybe you are not having control before, now you now have control as a result of that additional acquisition, or maybe you had control before, you now increased. You increased your controlling interests as well. That's basically the two scenarios here. Then I started with where a parent gets control as a result of piecemeal acquisition. I said the first thing we need to do is that the parent will have to remove that his initial investment from his books, because that initial investment is no more because it has increased now. So what we usually do is that we need to know, okay, what's the value? Because what we want to know is the value of his investment today. So, and now that he has separate investment, he had one before, now he has additional. So whatever it is, whatever value he has that old investment in his book before, he needs to update it. Or we call that, okay, we are derecognizing that old one by comparing that, okay, what's the value of that previously held investment today? Would compare it with the book value of that investment. When we do that comparison, the difference is a profit or loss on the recognition that the investor would recognize in his own books as a profit on this investment. Additionally, he can then go ahead and consolidate. Since he now has a subsidiary, since he now has controlling interest, he then goes ahead to consolidate. And when you want to consolidate, the principle is cancellation. We need to cancel out similar transactions. So, and similar transaction that is popularly cancelled out is the one that usually results in goodwill. By comparing the consideration transferred with the net asset acquired. In this case now, the consideration transferred is relating to a new or additional acquisition. Don't forget that it might have an existing holding. So we need to identify the fair value of the previously held investments. We need to know what is the value today. The fair value of the previously held investment. At the end of the day, we will then add the non-controlling interest, just like we always do. And all this is happening at the date control is achieved, at the date of that acquisition that made him have control. When you sum this together, you compare it with the net assets at the date control is achieved. And this net asset is share capital and pre-acquisition reserves. And that gives you your goodwill. Then you go ahead with some other calculations like your consolidated retained earnings and the value of your non-controlling interest. But if it's a situation where there is an increase in controlling interest, I told you that one means that there is a transaction between the owners of the company. It's like one entity is transacting with the parent. The parent is just buying more. And the parent needs to make that adjustment in his books by determining the adjustment to parent equity. And for you to determine the adjustment to parent equity, you will simply compare the fair value of consideration transferred. You will compare that with the people he bought it from, the value they are giving up, which is the decrease in NCI. Decrease, because NCI will decrease for you to have more holding. So fair value of consideration transferred, compare with the decrease in NCI, then that gives you the profit or loss or adjustment to parent equity that you're going to add to the consolidated retained earnings. Then we solved some questions. We solved a simple one that majorly focused on calculating goodwill and the profit on the recognition. And when we solved that question, I saw that to calculate goodwill, What gave us some tough time was this. We had different opinions on how to determine it. We had different opinion on the interpretation, but ultimately we understood that since the examiner gave us the consideration transfer, the amount we are paying to buy additional 50%, then for us to determine the fair value of the previously held 20%, we can use this 50% as a basis. That if the value of 50% today is 960, we can use this to calculate the value of 20, which we did as 20 over 50 times 960 to get the value of 20%. We can also use that as the basis to get the value of NCI, which would then be 30%. Since the parent holding in total now is 70%, that goes to show that the parent or the NCI will now have 30%. That therefore means that we can easily do 30 over 50 times 960 to get the value of the NCI if the NCI is measured at fair value. But in this question, we're told that the NCI is measured at proportionate share. Therefore, we can only do 30% of the net asset of the subsidiary at the date of acquisition, at the date control is achieved, which we computed down here, which is the share capital plus the pre-acquisition reserves, which is 1.5. Then doing 30% of that gave us 450. We added all this together, it gives 1795.4. We remove this to give us our goodwill. And the profit or loss on the recognition is simply comparing the fair value we computed up here, compare it with the carrying amount of the previously held equity instrument, which is how much we bought the previously held instrument, which is the 240 here. So we go 144. Then we move to another question, which was a more exam-related one, a complete question, where we are asked to determine the consolidated statement of financial position as at 31st December 2016, and also the consolidated statement of profit or loss and other comprehensive income, also at the end of 2016. Now, we're told that this guy used to have 25% before of Regis. He bought for that 35%, bringing him up to 60%. And making him achieve control in September 2016. Meaning this guy is getting control during the year. And that means we will need to then, you will have to consolidate at the end of the year, knowing fully well that the date of acquisition, the date control is achieved is September 2016. Now, with that in mind, to consolidate, we will need to determine goodwill because we'll cancel out. And when you cancel out, it results in goodwill. We determine how much he paid for the new acquisition, which we're told is 2.1 million that he paid in September 2016. We need to determine the fair value of the previously held 25%, even though this 25% he bought for 1,010,000, but we need to know what is the value as at the date of acquisition. We're not given a basis for that, but I can see that we're given the share price of the company. So if I want to get the value of this 25% today, I can use the share price by doing 15 naira multiplied by the number of shares he has, which is 25% of the number of shares in Regis. And since the share capital of Regis is 400 and the nominal value is 1 naira, it means the number of shares is 400. So if you do 25% of 400, then you multiply that by 15 naira, that gives me the fair value of that 25%, which was the alternative approach we used there. Alternatively, we can do it the way we did the last question. That since the value of 2.1 million, or since the value of 35% is 2.1 million, then we can use that as a basis for getting the value of 25%, which we can derive as 25 over 35 times 2.1 million. And that gives me 1.5 million. Now, when I get my 1.5 million, that means I've gotten the fair value of the previously held investment. Then I'm left with my non-controlling interests. And my non-controlling interests, I've been told in the correction that NCR is measured. They measure NCR at fair value. So in this case, we can also use a similar basis by saying that at the end of the year, NCR is 40%, since the parent now has 60% at the date of acquisition, I mean. So we can use the share price multiplied by the number of shares the NCI has, which is 40%, multiplied by 400. And when we do 40% multiplied by 400, that will give me the number of shares the NCI has. Then I multiply by 15 naira, which is the number of shares in the subsidiary. That would give me 2.4 million. And alternatively, I can use this 2.1 million as a basis as well. That since the examiner told me that we pay 2.1 for 35%, I can use that as a basis to get 40%. I can just do 40 over 35 times 2.1. It gives me what I need. And I get 2.4. If I add all this together, I get the 100% fair value of what was paid to the subsidiary at the date of acquisition, which is September 2016. Then I get the net asset acquired at the date control is achieved. Let me put it there, at the date of control. So the share capital of the subsidiary is 400. The retained earnings of the subsidiary at September 2016 is 3.9. If you remember, this is where we got it from, 3.9. And I gave room for a brand name because it was a balancing figure, because this is the net asset acquired at the date of acquisition. But the examiner tells me that the fair value of that net asset is 4.6 million. They even went ahead to tell me that the difference between that fair value and the carrying amount is Regis brand. That means this carrying amount of 4.3, compare it with the fair value, because what I need here is the fair value. I need the total here to be the fair value. So that means the excess of the fair value over the book value, they told me, is brand. So that's why I put this as balancing figure. When I compare this against the total consideration, the difference is the goodwill. With that in mind, I immediately determine amortization of that intangible asset, of that brand name, which is simply 300 over 5 years, because they told me that the useful life of the brand name is 5 years. The brand is estimated to have 5 years from September. And considering that the year end we are looking at is December, that means I can only depreciate these assets or amortize this brand name for 3 months. So I did 300 over 5 years. That gives me the amortization per annum. Then I prorated it for 3 months. So that gives me 15. Then I can get the carrying amount of the brand name as 300 minus 15, which gives me 385,000. Now I've gotten my goodwill, I've gotten my amortization. Don't forget that in the separate account of the parent, it would determine the profit of on the recognition of the previously held investment. Because now the previously held investment has a new value that we computed up there as 1.5 million. This. If I compare that with the carrying amount of that asset as at the date of as at the date I'm buying, I bought a new one. As at the date I want to remove it or update it in my books, the carrying amount is, I bought it for 1,010,000. But since this investment is an associate, it would have earned some post-acquisition profit. That's how we determine carrying amount of investment in associate. It is an associate. And how did I know it is an associate? Now that 25% is 25%, because I was told in the correction that this 25% enable him to be able to exercise significant influence over that regis. That means it's an associate investment. So that justified my ability to calculate this carrying amount by also adding its share of post-acquisition profit. And if you remember, when I wanted to do this post-acquisition profit, I paused a little bit, even though I can easily do it by saying that, okay, this investment, when I bought it, what was the retained earnings? It was 2.9. When I was exiting it in September, what was the retained earnings as at that date? When I'm about to give up that associate, it was 3.9. So there's a post-acquisition profit of 1 million. I can easily get that 1 million like that. Then I multiply by 20%, it gives me my answer. But I said, hold on. Let's determine our consolidated retained earnings first. And on that basis, we will then see everything clearly. And to determine the post-acquisition, the consolidated retained earnings, to determine the consolidated retained earnings, I would need my retained earnings with the share of my profits, the share of the profit of my investments. And the investment I have majorly is regis. Remember that up to September 2016, I had 25% of regis. Up to September 2016. So I will definitely share profits of regis till September 2016. Then from September up to December, now I have 60% now. My holding has increased to 60%. That means I will now be sharing 60% of regis for just 3 months, that's why I'm having this, just to explicitly state how I'll be sharing. Now, how did we get this 5.1 million? Is there anybody that can tell me? I've been talking. Let me hear you guys speak. This 5.1 million, where did we get it from?
It is in the question, sir.
Okay, let me go back to the question. How much is it?
Share capital of 1 naira under equity total assets.
We use share capital.
The share capital of the parents, the share capital of the parents, value of the share capital of the parents.
Okay, so what's the value of the
That's
share
mammoth.
capital of the parents? What is that doing in retained earnings? The question, what is it doing in retained earnings?
It's not on retained earnings, sir.
But we put it there now. Please, we are trying to get consolidated retained earnings, and we picked share capital of the parent for our retained earnings. What should it be? What should we have picked?
We should have picked the retained earnings of the parents.
Thank you very much. Thank you very much. We should have picked the retained earnings of the parents, which is 19,960. I think it was Mr. Christopher that called this figure for me. Somebody trying to say something, but the line seems not so good. So this is 19,960. Then when we had 25%, the last date we had 25%, because we cannot get beyond this. As at when we had 25%. The last date we had 25% was in September 2016. As at that date, the reserve of that entity was 3.9. And that's why this is coming here as 3.9. And also 60%, which is the year end, the Regis reserve is 3,950. That's the reserve of this subsidiary. 3,950. Then we can then remove the pre-acquisition retained earnings. When we acquire this 25%, the retained earnings of that entity was 2.9 million, which you can see in the question here. It was 2.9 million. And when we acquired this additional 35%, that pushed us up to 60%, the retained earnings of the subsidiary was 3.9 million. It was 3.9 million. And that's the pre-acquisition retained earnings that we have here. Then we can determine or derive our post-acquisition retained earnings, 1,050,000. And we almost forgot this amortization of brand name. It was somebody that reminded us, in which we computed up here of 15. So it is the brand name of the subsidiary. When it was a subsidiary, that was when we discovered this brand, and that was why the deduction is coming underneath here. So we have to remove this brand name, this amortization here. Then that bring the post-acquisition profit down to 35. Then let's get our share. We also brought in the profit on the recognition, which is 240 that we got up here, as part of the profit of the parent, because it's his own profits to be in his books. Then he gets a share of the associate when his investment was associate. All the profits of that associate to September after acquisition is 1,000. So 25% of that gives 250. And now when his investment is a subsidiary investment. The post-acquisition profit for that period from October to December is just 35. He gets a share of that as well. 21. I believe this is wrong. So what's this 5611? What should be the new addition?
$20,471.
20,471. At the end of the year now, the value of the non-controlling interests at the date of acquisition, the NCI was 2,400 at the date of acquisition. And we're going to share, or NCI is also going to get a share in the post-acquisition profits of that subsidiary, which we have calculated up here to be 35. So NCI gets 40% of 35, which is 14. Together we have 2414. Then we proceeded to preparing our statement, starting with the statement of profit or loss. We had to consolidate because now at the end of the year, we have 60% holding. So of course we have control, we can consolidate. But for P&L, we can only do a 3-month consolidation because we acquired control at the end of September. So we can only consolidate October, November, and December. And that explains the reason why we were only taking 3/12 of the line items of the subsidiary. So for the revenue, we did 5.1 million. We added 3/12 times 2,000. Did 3/12 times 2,000. Then that gives us 5.6 million. And you know that this 2,000 is this in the Regis account. Also, the cost of sales and expenses, we did 4.5. We added 3.5, 3/12 times 1.8, which is this 1.8. And also, we remember to add 15. This amortization of this thing. Amortization of brand name. And this profit on the recognition, we're rushing, it should come before the PBT. This 240 from our workings up here. Where is it? This 240 here. It should come here. Then when you accumulate it, can you help me get 560 plus this, minus this plus this? Then that should give us our PBT.
$875. 875.
875. Then I get my share of profits for the year of the associate. Remember that my investment used to be associate for 9 months. For 9 months. And usually when I have investment in associates, remember that I usually get a share of his profit and I put it to my P&L. So the profits of the associates, when this guy was associate, his profit is actually 160. He's associates for 9 months. So I did 9/12 times 160. When I do 9/12 times 160, I get the profits as an associate. Then I only take a share of my 25% of it. That gives me 30. Also, my income tax, like we have been doing, 180 plus 3/12 of the income tax of the subsidiary, that gives 190. This should still give us the same thing. Can you confirm? This plus this minus this should still be 715.
It's the same, sir. 715.
Still the same 715. Okay. So we then move on to OCI, and the only item in the OCI of the two entities is gain on property revaluation. I did 120. Then I only took 9/12 of this, which I did here. 120 plus, no, 9/12. It's 3/12 of this, which we did and got 130. However, don't forget that my investment in Regis was, for this year, was an associate investment for 9 months. That means this gain, I would also get a share of it, being an associate for 9 months. And that was why we did 9/12 of 30. And we got 30, right? This is wrong. Who can tell me what is wrong here? Something is wrong here. In this our calculation that we did last week. Can anyone spot it? Nobody. That means you haven't revised. So what we failed to do was that it should be based on our share. We only have 25% as an associate. So why are we taking the role of we'll just take our 25%. So what should that bring us to?
It's 7.5. 7.5, sir.
7.5. So what is 715 plus 130 plus 7.5? What will it give us?
$852.5.
852.
52.5.
Okay, now it's correct. Then we did profit attributable to, which is this profit? To owners of parent and NCI. So for NCI only gets a share of the subsidiary's profit for the year. And the subsidiary's profit for the year is 160. Now, we now did minus 150 before multiplying it by 3/12. This is absolutely wrong, because this 15 was after acquisition. It came up, we have already prorated this 15. We did it here. It has already been, it's a proration that led us to this. So doing this is absolutely wrong. So let's do 1/6, 160/3/12, which is NCI will only get 3/12 of the profits of that subsidiary, because it was only NCI from October to December, which is 3 months. So let's do 3/12 times 160 minus 15. What would that give us?
25.
25. We're now going to take 40% of that.
That's
10.
10.
10.
10.
So this will give me 710. No. Since this is 715, Abi, and NCI is getting 10, that means parents will get the balancing figure. So we usually get this as the balancing figure. So total still comes to 715. We'll do the same thing for total comprehensive income attributable to owners of parent and NCI. We made the same mistake. This 200, don't forget that is P&L. This is the 160 for profits. This is the 200 for total comprehensive income. We'll take 3/12 then before minus 15. So this cannot fly again. So what is 200 times 3/12 minus 15? What does that give us?
$35.
Okay, let's take 35. Let's take 40% of that.
14.
14.
14. If out of 852.5, 852.5, if the NCI is taking 14, what's the balancing figure?
68.5.
Sorry?
838.5.
838.5. This also balancing figure. 838.5. And now we have finished the statement of profits or loss. And you can see that what we did is absolutely correct, because independently, when we computed this, is the same thing as the share of his post, because he's sharing 3 months profits. His share of post that we got here is still the same thing. It's still this. It has to be the same 14, because it's just 3 months profit per share. And it makes sense that it's jiving.
So please, I have a question.
Yeah, please ask.
Please, why do you subtract the 15 naira from the profits?
Which of the, okay, I mean, we subtracted from the 2. And that's because this 160 that we are looking at of the subsidiary, this 160 was from the question. And don't forget that we had already made adjustments we had made consolidation adjustment to this profit after we acquired him. As a result of this, is as a result of the brand name that was introduced at the date of acquisition. So, and that 160 is not reflecting that. So the profit NCI is having a share of, is after adjustment for that 15. We need to remove that 15. And that is why we had to remove it. So it was removed here, which is why we only got a share of 35. If you don't remove it here, it's not balance. And that was why we also removed it here too, total comprehensive income, because this one includes everything. This total comprehensive income is this 160 plus other comprehensive income. So it's like anything you adjust here, you must come and adjust it here, because it's the same profit. It's the same profit. So that was why we removed this 15 from the profit, because it has not been adjusted for and there is an adjustment that was made that is not reflecting in the profit that was given in the correction, to get an accurate post-acquisition profit or the profit available for distribution or sharing, we need to adjust it.
Thank you, sir.
So, statement of financial position, December 2016. Assets, non-current assets, so yes, that's correct format. So if there's no adjustment, we'll just use it like that. We just use it like that. Okay. Now let's prepare statement of financial position. And the first item I can see here is PPE. Can you please help me add these two together? What is 19,325 plus 3,800?
23,125.
23,000.
125.
Just hold on with that figure. 23,125. Okay. Is there anything you are supposed to deduct? Is there any adjustment that should be made? You know now, there's no adjustment here that is to be made. So 23,125. Then our goodwill from our workings up here. How much is our goodwill? 1,400. Our goodwill is 1,400. Then any other item is statement of financial position. Okay, we have current assets, but before current assets, there was a brand name that we calculated as 285 here, carrying amount of brand name 285. So brand name, $285. Then our current assets. What's the addition of the current assets? What's the addition of these two?
7,450.
7,450. 7,450. $7,450. Okay. Is there any adjustment that need to be made here to this 7,450? Nobody? Remember, this investment that we made during the year, this 35% investment we made during the year of 2.1 million, we debited investments that we recognize at fair value in our books. We need to also incorporate the other leg of it, which is bank. We will have paid with money. That has to be incorporated. So that's 2.1 million needs to be deducted from our books. So these current assets, we need to remove 2.1 million. What does that give us?
5,350.
5,350. And the reason I have to make this adjustment, the reason I have to remove this is that when you look at this statement of financial position that we are consolidating, this investment of 3.1 that is here. Oh, it was already in the book, so no, we'll not remove it. It was already in the books. So what's this 2.1 plus 1 point will give us what?
3,110,000.
Okay. They have already passed the double entry. They have already removed it from their cash. For it to be inside here, that means it has already been recorded. If it was not, then I will have passed that entry. So this is not necessary anymore. It's purely 7,450. 7,450. Now, that means you need to understand exactly why. The why of everything, you need to be able to check it and understand it very well. So you see that I removed, you see that I removed the additional investments he bought before, thinking that it has not been recognized before. But when I went to his book, I saw that he has already recognized it too, that no, I should not remove it again. That shows understanding. So let's get our total assets.
$32,260.
32,260. Now, my equity and liabilities. My equity first. What's the share capital of this company?
500. 5,100.
5,100. Did they have any share premium or something like that? Okay. Retained earnings, consolidated retained earnings, which we got as 24 or 2471 as consolidated retained earnings. $24.71. Then non-controlling interests, which we got as how much? $2,414. NCI is 2,414. So can you help me add my total equity together?
27,985.
27,985. Then, can you help me add my liabilities together?
$4,275.
4,275. $4,275. What's the total?
32,260.
$32,260. Okay. And that gives me my account, and that's the end of this question. So if you're able to understand this question, that means you're able to understand everything that has to do with business combination achieved in stages, where the controlling interest is crossed, meaning you are starting from where you were an associate, then you then move to controlling interest. So this has a lot of the basic things you need to know. You understand this, you're good to go. You're good to go for this part of your syllabus. The flip side of it is this, is increase in controlling interest. Increase in controlling interest. So, which we already explained before. He said the facts are the same as in question 1 in the above section. They now say we should show the consolidated current assets, non-controlling interest and reserve. If Mammon acquired an additional 10% in Regis on 31st December 2016 for 700,000. So for this one now, the company acquires additional 10%, which brings up his holding from 60% now to 70%. So from here, the equity interest of Mammon has now increased from 60% to 70%. So this is an increase in controlling interest. This is an increase in controlling interest and will be treated as transactions between owners. And the only adjustment required here is an adjustment to parent equity. That's the only adjustment that needs to be made. And this is calculated as below. So what's the adjustment to parent equity? We'll determine the fair value of consideration transferred, which we're told he paid 700,000. Oh. Then I'll compare that with the decrease in non-controlling interests. And what's the decrease in non-controlling interest? our non-controlling interest has decreased by 10%. And ten percent of what? Is 10% of the net asset acquired at the date of this acquisition. And when is this acquisition happening? It's happening in December 2016. So as of December 2016, the net asset acquired is 400 plus 3,950. So I need to get this net asset acquired for you. Is the share capital. So at the date of acquisition, so share capital is 400. Retained earnings as at that date is how much? But I have to be very careful because from that question, I was given the fair value of, they gave me, no. This is as at September. Okay, so we are on track. But this is as at December. So how much is this? What's the total?
4,350.
4,350. So if you get 10% times 4,350, what does that give us?
435.
435. Now, the difference between these two is either going to be this, is an adjustment to parent equity, yes, but you need to know whether it's a profit or a loss so that you know how you're going to adjust the equity. So is this a profit or a loss? So the parent,
Loss. It should be loss.
yeah, is a loss. So that means since this one is in brackets, so it is a loss because the parent paid 700 for an investment that is only worth 435 at the date of that acquisition. It was only worth 435 and he paid 435 for that. So how much is it? How much is the difference?
265.
265. Now, having determined this, we're now required to determine consolidated current assets. So what's my consolidated current assets? So as per the last solution, we already have our consolidated current asset to be how much? 7,450. Abi? So this will be to be updated to 7,450. Then we will remove the payment for investments. You know that this one has not been entered. That 700 he paid to acquire additional 10%. This money is sent. This 700 he paid needs to be removed. So what's the balance?
$6,750.
6,750. Also, we have to determine the new non-controlling interest and reserve figures. So, as per the previous solution, the non-controlling interest was 2414, Abi? Yes, no.
Yes.
Yeah, 2414.
So you wrote
Then,
non-current interest.
oh, okay. And now there is a decrease in NCI. What's the decrease? This is 435. What's the balance?
$1,979.
1,979. And the consolidated reserves. So as per the last solution, what was it? It was 2471. But now there is adjustment to parent equity, which is how much? 265. So we get 265. What was the balance?
20,206 naira.
Okay. And that's the end of this particular one. Let me share this note with you now before I move forward.
Sir, hello, sir.
Yeah.
Sir, I just want to ask, sir, when the parents acquire a 10% holding, and it means it's pay more, I mean, than the amount of the holding, sir, is it not paying for goodwill as well?
The parent
Yes,
doesn't
in the
already
last one,
have the goodwill.
sir. No, sir. In the last one you did, the parents acquire a 10% holding, more holding, so it reduces the NCI. Now, what I want to ask is that the parent pay 700 for asset worth 435. Is the difference not goodwill, sir? Because it was recorded as loss here. So I just want to understand, sir.
Okay. I'm not getting what you're saying very well.
Okay, if we
Can
ask a
you come
question,
again?
sir. Sir, in the question, I was meant to understand that immediately we have a question, we have to calculate a goodwill, sir. And
Yes.
it says parent investment and NCI investment against the net asset. So we
Yes.
get a goodwill, sir. So now, as a parent, I bought more shares. I have reduced NCI. Now,
Okay.
the difference in the amount I pay and the asset I got, is it not goodwill? Is it not as well goodwill?
Are you talking about this one? Are you talking about
It is
this
what
one?
I'm, yes, sir, 265. Yes, sir, that's what I'm talking about, sir.
The amount I paid and the amount I got, is it not goodwill? Yeah, it looks like that because you are paying above, you are paying above your investment. It looks like that based on the explanation we gave for goodwill, but it is not goodwill. So it is not goodwill because goodwill cannot come up on a piecemeal acquisition, cannot come up from a 10% acquisition. Goodwill can only come up when an acquisition is a controlling acquisition, like an acquisition that gives you control. That goodwill will arise from valuing the entire business, not from this one is just I'm comparing how much I paid with the cost of my investment. That's all I'm doing. Compare it to when you're doing something like this, where we are comparing the total payments people have made for that business with the total value of that business. That is when goodwill can happen. Goodwill cannot happen from just I bought 10% and now paid, and this 10% that I bought, I paid 700. But the carrying amount of what I bought itself is this amount. So I now saw that that's a loss. That one is not goodwill. It's just a loss on that small investment. Goodwill arises from valuing the entire business. I hope you get the difference.
Yes, sir. I can cope with that, sir. Yes, sir. I got it, sir.
Yeah. So let me recap again because I can understand the fact that these things are not so straightforward for you guys. So let's recap over again. I've recapped the one we did. I intentionally recapped that one again. So let me recap this again for you. So what we're looking at is we bought additional 10% holding for 750. So, and this we did in December. This we did in December. Now, our holding would therefore increase by 10%. That is from 60% to 70%. And this is an increase in controlling interest and will be treated as transaction between owners. And whenever we have this, the only adjustment we need to make is just adjusting the parent equity. It's just to adjust the what? The parent's equity. And this is calculated below. You would compare the fair value of consideration transferred. You will compare that against the decrease in NCI. And this decrease in NCI that is happening here, we then did NCI is decreasing by 10%. 10% of what? We did 10% of 4,350, which is the value of, no. You see, these are the technicalities here. This is not going to fly. This is not decreasing NCI. This is the value of 10%. It should be the same thing. Let's what was NCI before? As of December, NCI was 2414, right? So it decreased by 10%. It decreased by 10%. So then that should be shouldn't that be 10? That 2414 is how many percent again? That's 40%, Abby. This 2414 is representing, yeah, that's 40% holding. That's what gives birth to this 2414. So 10 over 40 times, so if 2414 is 40%, then let's see what this gives us. Can you punch a calculator for me? What will this give you? Will it give you the same 435? I don't think so.
That's 603.5.
Much more. So we undervalue that decrease. So what would this balance give us now?
$96.5. 96.5.
Okay, so in the process of capping,
6.7.
oh, is this 603.3 or 603.5? Maybe there was one that did not. Can you do it again, please?
603.5, sir.
0.5. Okay. Now, in the process of recapping, I was trying to interpret again. I saw that we wanted to do decrease in NCI. We should be coming from the NCI perspective, which was 2414, then it decreased. It will not give you the same thing as doing 10% of, that's like a new acquisition. It will not work. It will not work. It will not be the same because this one will have gotten share of profit and all of that. So this is the correct position. That means all this is not needed here. So my decrease in NCI will be, this NCI has decreased by 10%. So since this 2414 represents 40%, is a 40% holding. So I did 10 over 40 times 2,414. So use that to determine the value of 10%. The value of 10%. Then I paid for 10% because why I'm doing it like this is that because we already mentioned that this is a transaction between owners. This is a transaction between the parent and NCI. NCI was the one that gave his holding, some of his holding to the subsidiary, to the parent for 700. So that means this 2414 of 40%, he gave out 10% of it. So if you now go and do 10% of the total subsidiary value to know what you gave up, that will be wrong. Then we are not interpreting it from the stamp. So you need to, these are technical things that you need to really sit down and understand. So this is 603.5. Then we eventually got 96.5. So I think the only thing it will affect here is just this. Yeah, 96.5. No. This is 603. Decrease in NCI 603.5. So how much is that?
1,810 naira 0.5.
So this is 96.5. How much is this?
20,374.5.
374.5. Okay. Do we have any questions? Or do you want me to go over it again? Because this is the end of business combination achieved in stages. This is the end of that. Any questions? Okay. Let me just introduce you to disposal. Then we can solve question the next time. Let's look at disposal of equity interests. So here, a parent or an investor can sell or dispose its existing holding. And these disposals of equity interests can result in any of the following. Number one is it can result in, let me say, subsidiary investments to subsidiary investments. This one is similar to transaction between owners. So this is where a parent retains control of the subsidiary. So, for example, the parent has 90% holding in a subsidiary and disposes 20% of its equity interest. So yeah, nothing is changing. It will still consolidate. It's just subsidiary to subsidiary investment. It reduces to subsidiary investment. Another one is subsidiary investments to associate investments. So this is where a parent loses control of the subsidiary. So, for example, a parent has 90% holding in a subsidiary and disposes 50% of its equity interest. So this is subsidiary investment to associate investment. So we need to know how to deal with this as well, because at this end now, at the date where he loses control, he will then not be able to consolidate that subsidiary in its books. He will then have to use equity method to account for that investment now, because it is now an associate investment. We need to look at that scenario. Another one is subsidiary investments to financial assets. This is also where a parent loses control of the subsidiary. So, for example, a parent has 90% holding in a subsidiary and disposes 80% of its equity interest. So it results in just a financial asset. So all of this we're going to look at. And of course, a similar one to subsidiary to financial asset investment is where the parent sells all of its investments. It sells all of it. So the first one, which is subsidiary investments to subsidiary investments. So this is a scenario. So this is a scenario where control. This is a scenario where control is retained. And in this case, we will treat the disposal as a transaction, between owners. And the only adjustments required is an adjustment to parent equity. Is an adjustment to parents. The only adjustment required is an adjustment to parent equity. So we need to adjust the parent's equity. And this is calculated as below. And how do we calculate adjustments to parent equity? We will usually we'll get the fair value fair value of consideration received. We'll compare it with the increase in NCI. So this is very similar to this one. But this one is decreasing. It's like this decrease, because in this case, we're buying more. So NCI sold to us. But here now, we are the one giving to NCI. So we compare these two, we'll adjust the parent equity. So the resulting figure is going to be a profit or loss, depending on whether we have received more or we have received less. If you have received more, then good for us. That will be a clean profit for us. However, where it is a subsidiary investment to an associate investment or a financial asset, see, this results in a loss of control. And the adjustment required are, one is for you to calculate the profit or loss on disposal in the consolidated financial statements. Also, profit or loss on disposal on the separate account of the parent. And the profit or loss on disposal in the final consolidated financial statements is calculated as follows. You determine how much did you received for the final disposal. How much did you receive on the final disposal? You will also determine the fair value of investment retained. You will determine the fair value of investment retained. Then that gives you the total worth of your investments. Whatever you get here, you compare it with the net assets of the subsidiary at the date control is lost, at the date control was lost. Additionally, this money you are receiving for this final disposal is not just the net asset of the subsidiary at the date control was lost. You are also going to lose your goodwill because you will no longer be able to consolidate that goodwill that you paid for. Another person has bought it from you. And I'm sure you'll have factored in the value of that goodwill when you were determining this disposal price. So, goodwill. However, if this is not a total 100% disposal, like in this case, we still have some investments retained. That means that in order to compare like with like, because this is 100% of the subsidiary. Let's say your total holding was 80%. You cannot compare 80%. Let's say your final disposal was, let's say, 60. But you still have 20. So this is representing money received for 80. But this is 100. To bring it to 80, you get the value of the non-controlling interests at the date control was lost. In this case now, we have to deduct to bring it to 80. When you compare this with the money received, then now it's going to give us our profit or loss on disposal. Additionally, the profit or loss on disposal in the separate account of the parent is calculated as the consideration received for the disposal compare that with the carrying amount of the investments that is sold. Carrying amount of the investment sold or the cost of the investment sold. The difference between these two will give us this. And that give us a sense of where we want to be. I will leave you guys. I will not bombard you. These are the questions we will solve for disposal. But I will give you the benefit of the doubt that you are going to revise this very well. So that when we come to class, you would be able to get this very fast, applying all of this you have learned. And I also need you to go and revise this and be able to solve it yourself so that at least you are sure that you understand this one very well. Then we'll finish up with disposal in our next class, which is going to be Wednesday for group account. However, we are going to progress with our combined class that we have on Sundays because we have not finished that associates. There is a correction that we did not solve to finish up associate. And also, I also want to carefully teach you consolidated profit or loss and solve questions. So try to make yourself available tomorrow from 10 to 12 for us to be able to do that. And when I'm done with that, that same 12 to 12 would have to continue, because it is there I'm going to teach you ratio analysis. That will be our next topic on that 12 to 12. I'll teach you ratio analysis. I'll teach you EPS on that, which are majorly what we have left. Those are the major topics. As soon as you are done with that, I don't see anything you guys have left at your level, except you just want to. The only thing you would have left now is those pilot questions. I don't know if any of you have seen it, but it's something we have to solve everything together. I need to solve everything for you. And of course, solve past questions. If you have, we definitely would have to solve past questions. But be sure that those pilot questions, you definitely see them in your exam. You would definitely, so we will solve everything carefully as it needs to be solved. Now, there's going to be a change for those of you that are taking case study, because we have quite a number of people that are joining us. That 8 to 12 class is not going to work for our case study. It's not going to work. So, because it feels that I'll be joining you guys with our VI center, and there are new people that are also joining for our case study, and more people will join. So I will communicate the time. So that 8 to 12, I'll still communicate it on the group. It's not going to, 8 to 10 will not work tomorrow morning. There will be a new timing for everyone. And it might be in the evening, maybe after we finish SBR, then we'll then go for our case study in the evening, maybe on Saturday. I don't know yet. I'll communicate the final structure that will be convenient for everyone, not that Sunday morning. But especially for the physical guys, they also prefer us they want to join you guys for case study online. They believe it's more efficient online than for us to come to class to do it, so that they'll also be able to see us as we write the report and all of that, as we promised to do for this course. Okay, so we're going to put it a stop for today. Please try as much as you can to revise this. Otherwise, it will be difficult for you to follow me. That's why I'm not even going. I want you to take your time to revise it. So I think we have some hands raised up. So let's start with Sarat. Sarat, sorry.
Good afternoon. I was going to ask about the sustainability part of SBR. What is it about, and when are we touching that?
I already taught you sustainability reporting. Your name?
I was not.
And that public holiday that we did class, and it
Oh,
was
that ability. That was group account now, associate.
No, Abi Michael. We did.
Yes, sir, you did it, that you used Dangote refinery as an example for us, sir.
Exactly.
Okay.
Yeah. But we're still going to do revisions on most of these things again. So if you missed it, I will share the video with you on the group.
Okay,
You can watch the video. If you have any questions, you will do it. I think the only one we did not even touch, I think we did sustainability reporting, we did integrated reporting. It was this corporate governance. Those ones is just for you to learn the content, risk management report, the content. I can still touch those ones, but I spent time on that sustainability reporting. I explained, and I told you where you have to ensure you read. That I know that those ones will come out. I pointed it out to you. If you watch the video, you will see all of that there.
Okay.
Any other questions?
Okay, sir. Please, sir, I want to understand why will a parent sell his interest? Is there any reason, sir?
Yes, a lot of reasons. A lot of reasons. So it could be immediate liquidity need, right? You might probably need cash flow to sort some other issues. Then you then decide to sell that other entity. And it could be strategic reasons. Strategic reasons in the sense that
Investment.
probably, yes, probably maybe he has seen an opportunity somewhere that he can invest in. Strategic reasons, maybe there is a change in his strategy in terms of the industry he wants to operate in. Maybe he doesn't want to be involved in this company anymore. Then he wants to move to another industry to operate. You can divest his investment in this and then go to another company to go and invest. It could also be reasons where it is regulatory. There are instances where the government can say that you are too powerful. You need to divest, like what United States is doing for TikTok. You know that TikTok wants to sell, but Donald Trump is saying sell. You cannot operate in US and no US company is on your board. So they are forced to sell a majority holding in that company like that. So I mean, several reasons. Is either immediate cash flow need or strategic reasons, so or regulatory reasons. Okay.
Thank you, sir.
Yeah, I'll see you guys on tomorrow. Please endeavor to join. All of this put together will make it a whole. We only have maximum time we're going to spend together, maybe in the next 2 or 3 weeks, except for the case study. Case study, we are going to be together till when the pre-scene comes out. Then we'll solve the pre-scene and all of that. So, but for you guys, maximum 3 weeks, we will be done with our classes. Maybe 4 or 5 times we're done. So, bye-bye. See you.